Welcome everybody to the third day of the Blockchain for Europe Summit 2021. Today we have our UK edition where we would like to shed some light on what our beloved friends in the UK are doing, and therefore we invited a very distinguished panel today to enlighten you a bit about that and compare what the UK government is doing versus what's happening in Europe on the regulatory front. And I would like to introduce our four distinguished speakers today who will discuss this with us. First one, and no particular order, Nathan Catania, he's partner at X-Ray Consulting. Then Tina Baker-Daler, she's the general manager of Crypto.com in the UK. Lucy James, she's the general counsel at Luno, and Matthew Nyman, who's a counsel at CMS UK. Welcome, guys. Thanks for having us. Before we start, a very small hint to the audience. If you have any questions, please put them in the Q&A sections and I will try my best to incorporate them into the discussion. Looking at what's going on the regulatory front in the UK and in Europe, there's some big discussion points we want to touch on today. And among others, there's the comparison between the two regions, but also topics like stable coins or market integrity. And then also the question is, are there any advantages or disadvantages if you're locating yourself in the UK versus Europe? And to start that with, I would like to ask Tina as the first one to maybe give us your view on what do you see, as you already worked on these issues for quite some time in the UK and also have experience with Europe. How do you see the difference between what has been discussed in the UK and how it's been discussed in Europe from a company's perspective? Tina, the floor is yours.
Sure. Well, thanks very much for having me, Robert, and Crypto.com. We're delighted to be here today. So I think that the major differences are really in kind of the systemic approach that the EU is attempting to take with MiCA versus the more market activity approach that the UK has taken so far. And what I mean by that is it seems like MiCA is really trying to address a unilateral playing field across the EU member states with some consistent principles across kind of end-to-end crypto asset go to market, right? So that could be from marketing to issuance to trading principles, etc. In the UK, the regulator and government is really focused on specific market activities and kind of a one at a time approach. And whilst that can be a practical way to address the most pressing concerns, I think where we're at the moment is it hasn't necessarily created the clarity and a level playing field in the UK, or the sense that the playing field is level in the UK from the industry. There's still a number of concerns. So I think both jurisdictions have approached concerns around AML pretty systemically, and the same in Europe as in the UK. And we know that AMLD5 has given basically the entire region kind of the same requirements. And so that's pretty consistent. From there, though, we start to kind of get into divergent areas. The only other area that I think that there is some consistency, and I think we're going to cover this later, is a concern around stablecoins and the potential systemic risk that could exist were stablecoins to become part of the payment infrastructure without any kind of regulatory guidance sitting around them. Now, I think that, in my opinion, the focus on stablecoins was really accelerated by the Libra, now Diem proposal. And that raised the awareness of not only crypto assets, but of kind of the payments element around crypto assets at the EU and certainly UK regulator level pretty significantly. And so we're starting to see policies come out around stablecoins, both with issuance, whether or not they're e-money, should they be segregated, all of these things that we see in traditional financial markets being applied potentially to stablecoins, and that's fairly consistent. But overall, I think that we're going to start to see this divergence now post-Brexit around the UK having an opportunity to potentially do something potentially that's strategically different from what might be outlined in MICA, or not. I think we're still waiting to see if the UK will take a follow-on approach from the EU, which we have seen previously in the past.
Thank you, Tina, for this great kickoff. Lucy, as you're operating in the UK as well, is there anything that you would disagree with Tina? Is there something that you would rather even more emphasize as something that's beneficial to being located in the UK? Or is there something that you're particularly worried on top of what we just heard?
Yeah, thanks. And thanks also for having me and Luno today. I think I agree with everything Tina has said. I think that's a really great summary. Probably the only thing I would add is that if we were to look for positives from the proposed approach in the UK, it's that they have given themselves sort of that element of flexibility. So with the intention that it'll just be, you know, objectives in a framework set at the higher level, and then with the regulators setting the rules, essentially. I think that potentially allows for the sort of fast-moving, quickly evolving industry that we're in, and it does allow them to better target new issues that arise, or even, you know, new technology that comes up. Whereas the MICA approach, just by nature of European law, they are reasonably slow-moving, and I think they might find themselves set in stone, whereas the UK might be able to address issues more quickly, which they've said is the intention. But of course, that does leave the industry with a lack of certainty, which we are all looking for at this stage.
Thanks, Lucy. Nathan, as you're sitting basically between the two regions to a certain extent, what's your take on that, also with the perspective on best practice examples from Europe? Is there something that you can say, like, there's still diversity in Europe, at least until we have MiCA in place, which might be in 2023, or at least on most of the provisions that we see in there? Is there like best practices? Is there something that, you know, the UK could pick up from them? Or do you think the UK's approach is already top-notch or best in class anyway?
Well, thanks for having myself and X-Reg here. I guess, yeah, just to really add value, I think, to these conversations and to really understand where we're at, sometimes it's good to take a step back and look at the crypto regulatory landscape in general. So what we have seen in the past years is that we're moving from a phase of, I guess, the Wild West, where there was no regulation other than in a few jurisdictions, to this sort of intermediary stage where there's various jurisdictions doing their own thing, implementing their own regional style regulatory regimes, and there hasn't been this sort of convergence, this sort of EU-wide approach until MiCA was announced. So certain jurisdictions have gone on their own way. We've seen jurisdictions such as in the EU, for example, Malta came up with a specific regime. Gibraltar, which now unfortunately is outside the EU, also was one of the early adopters and developed a specific regulatory framework. The general approach, at least for most jurisdictions, is to focus on AML initially, and then to build out other regulatory approaches after that. So we are at this stage where the crypto industry is sort of in this limbo phase, where they're undertaking activities in multiple jurisdictions, and it's difficult to know what it is you need to comply with. I would say, in terms of the EU versus UK approach, from a policy perspective, I agree with Tina. I would say that on a high level basis, at least when it comes to stablecoins, they are extremely similar from a policy perspective. You have this approach where stablecoins which are linked to a particular fiat currency and are kind of pegged, as the more common stablecoins are, seem to be pushed into this e-money bucket. So they're going to have to comply with certain e-money style provisions at least. And in Europe, they're basically going to be e-money itself. Then you go to this next level of stablecoins, which are these asset reference type stablecoins, where you are going to see certain protections, at least in terms of the assets and the basket of assets that are being used to stabilize the price. And in both type of regimes, you are seeing a lot of similarity in terms of this sort of significant systemic side of stablecoins. And again, I think Tina made a brilliant point when it comes to the Libra DM proposal, which has pushed a lot of policymakers to prioritize these kinds of activities. So I guess from a high level perspective, that's what's happening right now. This sort of what I like to call a regulatory minefield, because different jurisdictions are doing their own things right now, and it's difficult to know, especially as a crypto asset business, what you need to do depending on what customers you're onboarding, for example, where your key jurisdictional exposure is. So I guess in terms of best practice, at least AML CFT has to be a priority for most crypto asset businesses, because that's where there's a lot of international pressure. The FATF, for example, has pushed for countries to at least regulate crypto assets from an AML CFT perspective. So I guess in terms of regulatory risk and best practice, that's where we see the majority of crypto asset players focusing on. So having a strong AML CFT compliance framework is extremely important. And that is where, at least in Europe, we have seen with the AMLD, that's the majority of EU jurisdictions are pushing hard on crypto asset firms being registered or licensed. And again, no difference to the UK. We've got the UK crypto asset framework in place, at least for AML CFT. So that's where we're seeing at least the industry moving to comply with AML CFT related matters. And I guess in my view, at least, it's the first step. So that there will be other jurisdictions taking the lead from the EU, which is coming up with a more comprehensive proposal that covers not only, well, MiCA itself doesn't even touch AML CFT really. So here's where we're going to see a lot more development in things such as consumer protection, prudential requirements, and market conduct, which I know we'll discuss later in this panel as well.
Thanks, Nathan, for this overview. Matthew, as you're working for a law firm, and we discussed legal certainty already in this short period of time quite a lot, what kind of issues do you see with your clients in regards to legal certainty? Is it already very clear what they need to do in the UK, or is there still points where there's a lot of uncertainty, lack of clarity, and how should that be addressed? How could that be addressed? Is there an easy way out? Or is this something that needs more education, more discussions, or more integration of what the industry is doing into the regulatory process? What's your position on that, or your view?
Thanks, Robert. I've been really interested and actually somewhat surprised by the way our clients and the people that we speak to in the industry are approaching this. And there's a clear link between legal certainty or regulatory certainty and innovation. And I guess there are a couple of, or two or three themes there. One is that, on the one hand, a lack of regulation can allow for innovation. So on that view, the UK's sort of laissez-faire, relatively laissez-faire approach should favor innovation. But on the other hand, innovation requires investment. And as I think Lucy and Tina may have mentioned, where you have a lack of certainty, that frustrates investment. And so that's and what I've seen is that the business people involved in crypto, so the people who are investing or seeking investment, want to have certainty and are prepared to accept much stricter regulation in exchange for certainty. So a lot of people would rather have strict regulation now than the possibility of loose regulation in future, because it allows them to plan, it allows them to predict the future and therefore to gain investment. So as I said, I've been somewhat surprised by the lack of enthusiasm for the UK's approach. Perhaps the developers and scientists would feel different to the business people. So that's one theme that I've seen. And then another thing is, we're talking about legal certainty, but there's another question of practical implementation. So, the EU has, on the face of it, a much more certain path. The UK has said we'll wait and see, whereas the EU, as Tina has said, is taking a systemic approach and creating the framework rather than allowing it to develop and then picking off pieces to regulate. But in practice, we have seen in the past that new EU directives and regulations, even where they are simply upgrading or building on existing, can take a very long time. So, we've seen with, we saw with MiFID, Solvency II, legislative packages which took many years longer and created huge uncertainty and was sort of the worst of both worlds, because businesses had to continue, had to kind of hedge their bets because they weren't sure when things were going to be implemented. Conversely, we've seen legislation which is put through very quickly. I'm thinking back to EMIR, for example, which was sort of, relatively speaking, rushed through, but it left huge holes because they just hadn't had time to drill down. So again, it was sort of quick to be implemented, but had huge holes in it, which left uncertainty. Whereas on the UK side, and without wanting to turn this into a competition, on the UK side, we have seen, very quick implementation of new legislation in relation to crypto, but just generally in financial services, because the UK has now left the EU, we can move quicker by just, by virtue of not having to negotiate with 26, 27 other states. So that's just, I guess, something to look out for in the future, which is, how certain will the EU's regime be in practice? Will be something which we will find out.
Thanks, Matt.
If you don't mind, I just wanted to add to that. I definitely agree with Matthew. If you look at both in the EU and in the UK, the approach hasn't been finalized. We've got consultation on one side in the UK that's just closed. In Europe, we've got MiCA that's going through the legislative process, and these things take time, and it still remains to be seen what the final outcome and the final text will be. And just on MiCA, for example, it's quite interesting that in the past days, they released proposed amendments to MiCA. So the total number of proposed amendments to MiCA came to 1,160 proposed amendments, which now need to be considered in detail. So one of our team had the wonderful job of going through all 1,160 amendments and summarizing them. So it's definitely going to be quite a painful process to get the EU to agree on an approach to MiCA. And I agree with Matthew. I think it's, now that the UK is outside the EU, it could actually be favorable, and they could potentially turn something around quicker and maybe have a more flexible regime in place.
One thing I'd add to that, just to kind of, play devil's advocate for the industry, is yes, it takes longer to go through a systemic approach, and you're having thousands of amendments over periods of time, which sounds extraordinary, but some of them will probably be pretty significant. Some of them might be a little bit more administrative. The flip side of that is when the agility that comes from being able to look at each individual market activity and regulate specifically for that, and in a more practical or pragmatic approach, can also mean that some of these policies don't align across the board, right? And so we've seen that in some of the proposed consultation treatments for crypto asset. For example, one of them is the marketing of crypto assets and marketing conducted by crypto asset companies. And when you read through the proposal for just that particular market activity, it doesn't feel connected to the rest of the regulatory guidance that we have in place. And some of the initial requirements that were proposed were physically actually impossible, right? So one of them was that all marketing would have to be, when I say marketing, I mean customer communications, tweets, advertising, anything that a consumer would see would need to be reviewed by a FSMA regulated firm. Now, there are no crypto asset FSMA regulated firms. So who's going to be approving all of this marketing content for the entire community in the UK? So that's what I mean by there's just some disconnection. And so one of the positives of having a little bit of a slower time frame is that some of these idiosyncrasies kind of come out in the wash over time, right? And it slows down the process a little bit so that it can be a little bit more considered. And that is just kind of the devil's advocate flip side to being able to kind of come up with policies on a market activity basis one at a time, which may not necessarily sync up across the rest of the market activities in a particular region when taking that approach. So I think that's just something that we need to be mindful of.
Thanks, Tina. Maybe a question to you, Lucy. I mean, after hearing what Matthew said, and you're part of the industry, would you agree with that? Do you think that's a reasonable trade-off, or is this surprising to you?
Sorry, which part of that?
Sorry, maybe I should have added what I'm referring to. The point that a number or a lot of firms based on the experience that Matt, for example, had, is there was a trade-off basically between harsh rules and legal certainty, rather than having a more loose, innovation-friendly regime that might not enable them to collect the investment they maybe need or want. Is this something you would agree with, or is this something that's surprising to you?
Yeah, I think it's an interesting point. And I think it probably depends on where in the industry people sit. I think those that are on the sort of cutting edge, or in the sort of, I don't want to say the fringes, but not sort of the core crypto products, they are going to be worried by regimes like MiCA being put in place that are set in stone now and allow very little room for movement. But if you're confident where your products are and where you're going, and I guess if you know that where you're going to fall within the current regimes, your preference is going to be for certainty, because that is ultimately going to help you grow and develop. And also, I think we have to remember, people outside of the industry are looking for there to be regulatory certainty, and to know that the industry is regulated. You know, we still have to work with the traditional financial services sector. So I think sort of overall, I would agree that the industry preference would be for certainty, even though that may come at the cost of innovation. But I can certainly see that there will be some people who are particularly worried about the sort of limitations that might be put on by an approach that sort of sets the boundaries very early on.
Thanks, Lucy. Maybe that's a good segue to the next point that we would like to discuss, and that's stable coins, because as I think was briefly mentioned already, there's a bit of a different approach towards stable coins. There's been a lot of, I wouldn't say, or maybe it's the right word, even fear about what it is or could be based on what DM proposed. Just asking you, and please first come, first serve. What's your view on that? Do we take, and I think in this case, as was flagged earlier, Europe and the UK are aligned on this, to take a rather stringent approach. There are some nuances, obviously, between the UK's approach and the Europe's approach. But what's your take on that? I don't know who would like to answer first. I don't want to pick somebody.
Well, I can start.
Please
so
go.
I think from the consultation that was put out, there were kind of a few key things that stood out from an industry perspective, and that was the reference that the UK government was making to stablecoins being systemic. But there was no definition of systemic. So really trying to kind of get a baseline of what we're talking about here when we're talking about systemic, and what does that mean? Systemic for what? Systemic risk, systemic for payments, and what would that look like? Because that kind of definition, I think then will inform the rest of the policy approach. There is a significant difference between a private stablecoin, like something Facebook was proposing with DM, versus something that is pegged by a one single fiat currency, for example. And as Nathan was saying, even still different by something that is pegged by a basket, and the assets that sit within that, and how are those treated? Do they need to be, segregated or safeguarded in some way if you're going to look at stablecoins as e-money? And then there is how we apply taxation for stablecoins, because HMRC considers crypto assets to be property, not money for tax purposes. So, how are stablecoins going to be treated? And that was something that didn't necessarily, come full circle within the consultation. And then the accounting treatment. So much like the taxation issue, if crypto assets are considered intangible, then how are you going to account for them on a balance sheet, which is a significant concern for companies. So I think broadly speaking, placing stablecoins within the e-money existing legislation makes sense in a number of areas. But I think we just need to understand exactly what those stablecoins are and how they behave, and ensure that we understand that not all stablecoins are equal and structured in the exact same way, and that we might need to have different applications of that guidance based on the structural makeup of that particular stablecoin. So I think it's a good start. But clearly there's quite a lot of feedback that went back to UK government in the consultation.
Thanks, Tina. I don't know if Matt or Nathan, you want to comment on this easy to solve issue?
I'm happy to add to that, I guess. So as part of the work we do at XRIG, we do a lot of work with policymakers, governments, regulators. And if you look at the overall approach that many policymakers take, is that they take a look at the regulatory risk. And what they want is a regulatory regime that can mitigate those regulatory risks. And I think when it comes to the more, I guess, centralized private stable coins, where you've got an entity issuing a token that's backed by a pool of assets, the reason why many policymakers are fitting it into the e-money type regime is because it's extremely similar. And when you have these products that, irrespective of whether they're using DLT or they're issuing a token, I mean, if it quacks like a duck is probably a duck. And I guess as an ex-regulator, that's the view I would also take. So you have these private issued stablecoins, which are very much like e-money, being pushed into this basket of e-money type tokens, because the risks are very similar. You've got a centralized entity issuing these assets, and the value of the asset is almost exclusively backed and protected by this single entity. So personally, I'm not surprised that policymakers are taking this approach to these more centralized types of stablecoins. Tina does make a brilliant point, though, that again, not all stablecoins are created equally. And as you start moving to these more sophisticated, in my view, more innovative stablecoins, such as I don't know, if you look at companies or if you look at stablecoins such as DAI as an example, where you have this more algorithmic type of stablecoin, that's where the risk profile changes. And because the risk profile changes, I would strongly suggest that policymakers take a different view to these types of assets. So I think the real risk we're seeing is if we try and fit a square peg into a round hole, and we try and push stable coins that don't quite belong into the more traditional regulatory approaches, that's where we're going to encounter difficulty. I do quite like, though, the fact that if you look at both the UK approach, they're carving out algorithmic stablecoins, at least in the consultation. They mentioned that they see that as more as a traditional crypto asset, because the value isn't quite backed by an underlying or linked asset. And even in the MiCA recitals, they do mention that they wouldn't consider stablecoins or algorithmic stablecoins to be asset reference tokens. That being said, the recital in MiCA is not as clear. And I think it mentions something along the lines of, if it's not referenced to an asset, then it wouldn't be considered an asset reference token. So you might even see some algorithmic stablecoins being considered asset reference tokens on the MiCA, which personally I think would be extremely challenging, as some of the requirements for asset reference tokens would make it impossible to have an algorithmic stablecoin in the EU. So I think that's just a potential risk of trying to push activities into buckets that they don't belong. And as well, taking this blanket approach to regulation where every new innovation needs to be fit into an existing regime. I think there could be different approaches that could be taken that really respect the underlying technology and that mitigate the risks, but in different ways, rather than just simply pushing them into an existing regime.
Thanks, Nathan. You touched on a very interesting point there. You know, it's something that we're discussing without really discussing it, but somehow it's part of it, and that's DeFi. And it would be interesting to see, you know, because at European level, I was involved, or I am still involved in these discussions. It's still very difficult for regulators to grasp what it is and categorize it in a way, even when excluding it from, you know, MiCA. I mean, there's common agreement that it shouldn't be in there. They're trying to manage that, but it's very difficult to do that. What recommendation would you give to UK regulators to make sure that, or if it should be excluded, to exclude it from upcoming regulation and let it play out in the next years before we actually think about what to do about them? Anybody having a particular view on that?
Well, I could just say really an observation that an advantage of the UK approach is that, you know, and I guess the sort of common law approach versus civil law is that everything is permitted unless there is a law, you know, unless the government wants to come along to prescribe it. So, you know, with MiCA, you've got this, you know, as you difficult problem of excluding DeFi. So maybe that means that, well, I think it does mean that the UK is going to be a more friendly environment for the development of DeFi for the foreseeable future, because you know, there is no discussion at all of regulating it, and there shouldn't be any questions of perimeter. I mean, there are questions of mostly unexplored of whether existing regulation applies to DeFi, but I think that could be one advantage of the different approaches.
I think if we look at the UK's approach to, I think, kind of regulating on market-based activities, one of the concerns that I have potentially, just following on from what Matt has said, is, you know, if you're looking at potentially, if something isn't replicating a traditional financial service today, then that's probably going to be kind of, you know, in this out of the perimeter area. But if something is, and, you know, potentially you have a product that produces a yield or a reward of some kind, we have seen regulators in the UK and elsewhere questioning what kind of consumer protections are placed around that activity. And I think we all know that that is regulators' primary concern, right? To protect consumers, and then, you know, as a secondary to kind of oversee the integrity of the market. One thing that I think we probably don't go down the rabbit hole completely, but recently FATF in their new guidance has come out to say there's no such thing as DeFi. If there is a service being offered, someone must be offering it, which I don't think is the most informed view, right? That surprised me. But when you have global standards bodies making these types of statements, what it says to me is a industry that we need to do more to kind of bring them into the education process, because we're back to, do we regulate code, right? And I think that we all agree, and regulators have agreed that we don't. I think what's unique about the UK and where the real DeFi opportunity is with back in that, you know, original innovate sandbox environment. So these types of products and services are basically kind of tailor-made to go into a regulatory sandbox and kind of innovate at pace with the regulator hand in hand, so that they can get an understanding and pave the way for other firms that are offering these types of decentralized financial services. And, you know, I would encourage people who are considering offering these types of services and want to attract an audience or partners that are already playing in the regulated space to look into the sandbox, because that really is the environment that is designed to kind of iterate in new areas with the regulator kind of in partnership. And I think that has proved to be very effective in the past.
Thanks, Tina. Actually, I would like to throw in a bit disconnected, but still also to include our audience a bit, a question that we received. And the question is as following: when do the panelists see a better environment for crypto firms obtaining relationships with banks across the Eurozone? Anybody having a particular view on that?
I'd just like to say, at least in my view, again, I think when I kicked off the conversation, my first input was that we're in a phase where crypto regulation is developing across not only the EU and the UK, but the world. So the FATF changes for me were one of the fundamental steps towards that. So because jurisdictions now are being pushed to regulate crypto, at least for AML CFT purposes, I imagine that we will get to a stage over the next few years where the majority of the crypto asset industry is regulated, at least the centralized players. And yeah, maybe it's not worth going into the DeFi rabbit hole, but the very centralized players definitely are going to be regulated for AML CFT purposes. Depending on what jurisdiction you're under, if you're under a solid regime, and the UK seems to be quite a strict one, given that it's taking a while for the FCA to let people in, we will see banks become a lot more comfortable with dealing with crypto asset players. I mean, the main concern that banks have had over the past few years is that they were dealing with an unregulated industry that didn't have AML CFT controls in place. And that's where the main regulatory risk is coming from as a bank onboarding a crypto asset business. So in my view, at least over the next few years, we will see banks getting a lot more comfortable as crypto asset firms are being regulated. I think the travel rule as well will make them a lot more comfortable. So as crypto firms are complying with the travel rule, they'll be operating to similar standards to other financial services, AML regulated businesses as well.
Thanks, Nathan. No, Lucy, you wanted to say something. Sorry, I didn't want to.
No, that's fine. It was really just to say exactly what Nathan said. I think the impending regulation is going to help enormously with those relationships. I think from an industry perspective, sort of the speed at which it's moving or not moving is a bit of a concern on that front. If traditional financial institutions see regulation coming and decide to wait, that's obviously, probably 2 or 3 years still in Europe where there are going to be issues with those relationships. So I guess from that perspective, that's another tick in the certainty box that we're looking for that sooner rather than later.
I'd also like to add, I guess, that education, I think, is going to play a massive part as well. I still feel that there are members of compliance team members, even in banks, that maybe don't fully appreciate how transparent the blockchain actually is and how using blockchain analytics, for example, can mitigate the risk or the AML-CFT risks even better than in the traditional world. So I think as education ramps up as well, that should hopefully help the banks get a bit more comfortable too.
Yeah, I think you made a very important point, and we've seen this also in discussions with regulators across Europe, that once they understand actually what is happening or we try to achieve as an industry, they're much more open-minded. And I think it's really a very important point, especially when it comes to DeFi, where a lot of people, it's a complex issue, you cannot really blame anybody involved to not understand it at first try, because it's complex, it's a lot of diversity, it's so fast moving, there's a lot of development going on. To predict the future of the DeFi market is basically impossible now, because in 6 months, everything might have changed in a different direction, simply because it's so early stage. And I think it's also important, to take away the fear from regulators, to not overreact. And I think what you described sounds like a reasonable approach to a certain extent, what the UK is doing. And I think in Europe as well, there's a lot of awareness that there needs to be a bit of slower pace when it comes to this topic. But on the other side, they're under the pressure of fulfilling their mandates. So I think as an industry, we have the duty basically to guide them and when to trigger their duties basically and make them ready and understand. So I think that's something that's really up to us. But as we're coming to a close of our panel, I would like to ask one last question to everybody of you. I mean, we discussed now the differences and the overlaps and the alignments between the UK and the EU. Looking at those, what are the takeaways that you would give to other industry players in the space on where to locate yourself, where do you see the benefits? Is there benefits in being in both of those jurisdictions, or do you think rather the UK is the place to be when it comes to open-mindedness and innovation or investment? What's your take on that? Maybe we start with you, Nathan.
Yeah, I guess my short answer would be it depends. So I think it depends very much on what entity you're looking at, what jurisdictions you're looking to target. I would say that there will be a point in time, I imagine, and it's a bit of a shame because we don't have this uniform regulatory approach, which would be ideal, but it doesn't exist even in the traditional world. And I feel that we're going to be in a similar position in the crypto world as well, where if you're a large player, at least, you will probably need to have operations in multiple jurisdictions and markets. So for example, if you want to benefit from the EU market, it's likely that you are going to have a EU regulated MiCA compliant entity. And if you want to benefit from the UK market, you're likely going to need a UK compliant entity as well. And to be honest, it is a bit of a shame that we don't have this uniform playing field. I guess it's maybe a bit of a political point as well. But significant players are going to have operations in multiple jurisdictions. And that's my view.
Thanks, Nathan. Maybe in 1 minute, Matthew, what would you add to that? Or do you disagree maybe, or agree?
Well, I would never disagree that it always depends. That would always be my answer. So I'm with Nathan there. I think you mentioned the political aspect, and we're still at the early stages of the post-Brexit negotiation. And I think an interesting question will be the cross-border arrangements. So, right now, let's ignore the delays with FCA registration for AML, which you can't, but just putting, let's say that gets resolved in the next year. The UK is going to be much more free and easy to operate in as a jurisdiction for crypto. And the question will be, can you offer your services cross-border into Europe without having to deal with the regulation there? That would make the UK much more attractive, I think. On the other hand, right now, if you're based in Europe, because the UK is lax, relatively speaking, you can provide your services, crypto services, cross-border into the UK. So yeah, there's no straight answer. We spend a lot of time working with clients looking at jurisdictions around the world in terms of jurisdiction shopping, essentially. And the UK seems to be the best major jurisdiction in terms of just being allowed to get on and do your business, aside from the FCA registration point. On the other hand, if you want certainty, then you would need to have you would need to have several entities, as you've suggested.
Thanks, Matt. Lucy, anything to add to that from an industry perspective?
No, I mean, I agree. People are probably going to end up in both the EU and the UK. And I think what the industry needs to accept is that with the differences we're seeing, not just EU, UK, but all around the world, so an acceptance of the cost of compliance and regulatory compliance is just going to be enormous. And I think the industry needs to be prepared for that, particularly until we do start to see a bit more of a unified approach across the globe.
Thanks, Lucy. And to go full circle again, as we started with you, Tina, I will also end with you. Is there any, maybe as we heard, I think all the concerns and the potential scenarios playing out, any last wish that you would like to hand over to UK regulators on the note that on what we just heard, maybe in one sentence?
Well, if I go back maybe 3 years, we had a lot of engagement between the regulators, not just the FCA, HMT, Bank of England, within the crypto asset task force. And a number of really good policy decisions came from ongoing roundtables and informal discussions, and there was quite a lot of engagement with industry. So as we kind of have rolled forward and guidance is starting to come out, there has been a bit of a pause to that ongoing engagement. And I would just suggest that, working more closely with industry would help to inform thinking. And once again, the industry is probably going to identify blips in the matrix before the regulator is, and working with us more closely, I think would help to establish fit for purpose and balanced frameworks going forward.
Thanks, Tina. And on this note, I can only agree to that. And that's why we're also doing this event, to offer a platform for regulators to participate and engage and discuss with the industry, and for us, to build networks with the regulators to help them do their jobs. And I think that's really what we're all trying to do. And we really try to support, the efforts, because in the end, everybody profits. Regulators can say that fulfilled their mandate, and the industry can say, look, we build cool things that push humanity forward, makes the life of everyone better, and we even make probably some money with it. So everybody profits. And on that note, talking about money, we unfortunately also have to talk about taxation. And for that reason, I would like to hand over to Ian, who will moderate the next panel on exactly this very light topic. So thanks for watching. Ian, I think you're next up.